taking the time to visit with us on behalf of the entire BUI team. Welcome. I'm very excited to introduce our speaker today, Bobby Samuelson. But before doing so, I want to hit a couple of quick housekeeping items. Number one, this meeting is approved for 1 hour of CFP continuing education credit. If you are a CFP and in need of continuing education credit, as soon as I'm done with my comments, I'm going to post a link in the chat feature of this meeting. To get to the chat feature, you just need to hover your cursor over the bottom of your screen. You click on that link, you enter in your information, and we'll make sure that you get the credit. If you're not a CFP, there's nothing you need to do. If you are a CFP, make sure you enter your information in during this meeting to make sure that you get credit. Number two, you probably are aware that there has been significant tax reform proposed. I know of no one who is more in touch with the legislative changes and has their fingers more on the pulse of what's going on than BUI's Director of Advanced Planning, Brian Siegel. If you are in an advisor group and your group could use an update on the current legislative changes, please reach out to anybody at BUI and we will coordinate a meeting to have Brian come and join your group, let you know what's going on, answer your questions, and help you with planning ideas. We've done this a number of times. It's gone over very successfully, so much so that advisors have asked Brian to come in and present those changes to their clients. And one of the biggest benefits of working with BUI is that you have access to an attorney, a high-level guy to be on your team. Might as well use it. Number three, this meeting is going to be recorded. Before the end of the week, we'll have it edited, uploaded to YouTube and sent out to you proactively. You don't need to reach out. It will come from my email address, bsteck@buiusa.com. So make sure that you have me whitelisted. And again, before the end of the day on Friday, we will have this recording up to you. One thing that we will ask is that while we want you to be able to use the recording for in order to help your clients and to share with other advisors in your office, please do not share it publicly without Bobby's express written permission. Lastly, if you have a question you would like to address, please send it to me in the chat feature. Again, that's located at the bottom of the screen. When you open the chat feature, you're going to see a drop down. It'll say everyone. And then if you click the drop down, select my name and send it to me individually. I will then try to gather up the questions and make sure that the most common questions get addressed by Bobby. The goal is that we get all questions asked, but want to make sure that we're also cognizant of the time. So without further ado, I'm going to introduce Mr. Bobby Samuelson. Bobby is an actuary. He is the former head of product development at MetLife and Bright House. He is the executive editor of the Life Product Review, which if you don't subscribe, you really should. Lots of really strong content about what's going on with products in the life insurance market. And he's the president of the Life Innovators, the sharpest guy I know in the life insurance industry. If you haven't seen him before, you're going to be glad that this is recorded. You'll know what I mean about 10 minutes in. If you have seen him before, you're going to get exactly what you came for. Strong content, and within an hour, you're going to be able to walk away being able to provide better resources and better planning options for your clients. Really excited to introduce Mr. Bobby Samuelson.
Thanks, Brant. I appreciate it. I am excited to be here as always. I love doing stuff with BUI. It's kind of rare in this business to have so many like-minded people working together. And I feel like that whenever I work with BUI. Only thing I'll correct in my bio, excuse me, you said a lot of nice things about me. I'm actually not an actuary. I did have 30 of them that worked for me at MetLife Bright House. And so sometimes I act like an actuary and play like an actuary, but I'm not officially an actuary. I like to say I have way too much personality to be an actuary, but I know a lot of actuaries with a lot of personality. So that's not even a really accurate joke. But anyway, it's great to be here. You know, this presentation kind of came about because I wrote an article for the Life Product Review, which you can see the site down there, about premium financing. And in particular, it was sort of a response to a recurring, consistent theme of questions that I was getting from all kinds of people. So one of the weird things about my kind of role in the business is that weird, and one of the best things about it is that I get things sent to me from all corners of the industry. So agents send stuff to me, brokerages send things to me, carriers send things to me, and surprisingly enough, people find me on the internet and send me things. I mean, I've had folks worth $100 million cold email me out of the blue saying, hey, I got pitched this life insurance deal and I don't know what to do about it. And so I went online and I Googled stuff and I found you. Would you mind helping me out? And that probably happens, I don't know, 5 or 6 times a year. And so I wrote an article about the fact that I was getting sort of a very consistent, very regular type of proposal coming my way that was leading to the same sort of conversations with clients over and over and over again, where I was talking about the same things. And that all revolves around premium financing. And, if you think about it here, the good, the bad, and the ugly, these are the ugly deals in premium financing. And so I wrote an article that said, look, this is what I'm seeing, and this is how you respond to it. And this is kind of the way to think correctly about some of these deals and kind of structure them the right way. And so that led to BUI reaching out and saying, hey, would you mind doing a presentation about the good, the bad, and the ugly? So that really is a structure today, talking about what is good in premium financing. How has premium financing traditionally been used, sometimes with much success when you have the right client? What is the bad? And then what is the ugly? What is the stuff going on these days that really is very aggressive? And as you'll see a little bit later, very unlikely to succeed. It works great on the illustration, but when you actually run it through the real world, it just flat out doesn't work, at least not very often. So that is the structure of the presentation today. We're going to save plenty of time for questions at the end, as Brant mentioned, so feel free to fire them away. I'm going to try and go about 45 minutes and leave time, because I know for sure that you guys have stumbled across some of these good, bad, and ugly premium financing deals, and anything is fair game in the questions and answer section. All right, so let's start with the good. This is the fun part. So we're going to even go back below premium financing and say, look, let's look at just straight up traditional life insurance transaction. You basically have 3 parties. You have a client, you have an insurance policy, you have a contract, and then you have the beneficiaries. And what happens? The client pays the premiums into the life insurance policy. When the client dies, life insurance policy pays the death benefit to the beneficiaries. And along the way, the client has access to the cash value. Now, they may not ever actually access the money. They may not need it for anything. They may not actually do anything with it, but they have value inside the contract. They have equity essentially built up inside the policy in the form of cash value. And again, whether they access it or not is a totally different question. So that's a traditional life insurance sale. Now, how does premium financing bolt onto a traditional life insurance transaction? Well, it looks a little bit of something like this. You still have clients paying premiums and the policy paying death benefits to the beneficiary. However, we're now inserting a third party into the equation. We are now inserting a commercial bank, and we'll go through a lot more detail in a minute on what this typically looks like, where the bank is loaning premiums to the client. Now, sometimes there's a trust involved. The bank loans premiums to the trust, but I'm trying to keep things simple today. So we're just going to say in this situation, the bank loans premiums to the client. The client then pays the premiums into the insurance policy. The cash value is now posted as collateral. Now, there may be excess cash value that the client technically could access, but as you'll see, typically almost all that cash value is tied up in a collateral requirement to the bank to satisfy the loan balance. And any excess collateral, and there is almost always excess collateral, well, actually there is always excess collateral, the client also has to post to the bank in order to satisfy the loan balance. So that's the basic lending structure behind this deal. And at death, the loan is either repaid at death, or in some situations, and we've seen this a lot recently, there is either a withdrawal or a loan taken from the policy to pay back the bank. So essentially, the bank is either paid back with cash from the policy, or the bank loan is refinanced into a policy loan. And you'll see later a lot of proposals use that strategy. So that's kind of one way to satisfy the loan using the life insurance policy. Or the client just literally pays the loan back out of pocket. Why would a client do that? Well, imagine a scenario where the client has, for example, outside assets. Those assets have grown significantly in value. And so the client premium financed for sort of a short period of time and then got a big liquidity event and decided, you know what, I'm going to take the bank out. I want to keep the insurance policy free and clear. And so they actually pay the loan back out of pocket. So every premium financing arrangement that I've ever seen, with the exception of a few, has some sort of an exit strategy. It's either repaid with a policy withdrawal, refinanced with a policy loan, the loan is paid back out of pocket, or, and I wouldn't even really call this an exit strategy, but the loan is repaid at death. At some point down the road, you've got to satisfy this loan that's been created. All right. So why would someone do this? Well, there are a few good reasons why someone does this. And the one that I've seen sort of, and I'll tell stories about this, but I've seen clients fall in every one of these buckets as I was kind of making this slide this morning. The one that I see the most is kind of the classic premium financing fact pattern is a client who is generally illiquid, but needs permanent insurance. And I'll give you a great example of this. So 2 weeks ago, I got pulled into a case with an agent who has kind of stumbled into a big potential transaction with a very wealthy family down in Florida. But this family's wealth was entirely tied up, like 100% tied up in a shopping center in Florida. Now it's a big shopping center and they're worth, tens of millions of dollars. But they're pretty illiquid. Now they have a clearly defined estate planning need. So there's a clear need for permanent insurance, but the client really doesn't have the cash flow right now to pay the size of premiums that they would need to pay to get permanent insurance for life. And so what are they going to do? Well, they're going to premium finance it. This is the idea. They're going to premium finance it because it helps with the cost up front. And they kind of have a planned exit in the next, or a refinancing event in the next 8 to 10 years. And they can use some of those proceeds to exit the loan in the future. And so what is premium financing doing? Premium financing is basically satisfying a liquidity issue where the client needs the permanent insurance, but isn't really liquid enough right now to pay those premiums. Premium financing can kind of bridge that gap. And it's a time gap, it's a defined 5, 8, 10 years or whatever it is between the need for permanent insurance, but the liquidity to actually pay the premium. Similarly, we see a similar sort of phenomenon playing out where if the client has very high yield opportunities, then the client says, well, I'd rather than paying premiums for the insurance that I know that I need because I have an estate tax issue or a business planning issue or whatever it is, I want to keep my capital working as effectively as possible in my business. And this is usually the way it works. So I have a business, I've got a small business, I'm not very liquid, and this business is growing at 50% a year. Why would I take my money and put it into life insurance when I can borrow money and keep my assets invested in my business that's producing 50% or so a year, recognizing that at some point down the road, businesses like that tend to get acquired. There will be a liquidity event. So this is not a forever thing. And that liquidity will go back to satisfy the premium financing loan. And at that point, the client will own the policy free and clear and be able to use it for its intended purpose for estate planning. So that's kind of illiquidity, high yield opportunities tend to kind of go together because a lot of illiquid things are also very high yield opportunities. But the same thought pattern sort of exists, which is, we know we have a permanent need, but we need to bridge this gap between the future and the present. And premium financing allows you to do that. Another situation, and we'll talk about this, I think, a little bit later on, is a client says, I really want to do estate planning, but I want to minimize gift tax friction. So maybe I have, for example, a GRAT or some other assets that are going to be moved out of my estate into a trust. If I buy the insurance policy in a trust and I do premium financing, then my outlay today is less than if I was to pay the premium out of pocket. And therefore my gift tax friction is less today than it would be if I was to pay this out of pocket. And instead, I may be using my gift tax exemption to put an asset into the trust that will grow in value and eventually pay off that premium financing loan and be, again, free and clear inside the trust, have the insurance policy do what it's supposed to do. So these are the kind of classic planning conversations that come around with premium financing. And then there are sort of a couple of other random scenarios where I see people get attracted to premium financing, even if they actually are pretty liquid, if they don't really have high yield opportunities, or if they may not even be doing sophisticated estate planning. And that's simply if the client is accustomed to leverage and feels like he or she understands the risk. The classic fact pattern here is a real estate developer. I cannot tell you how many real estate developers I've talked to who say something to the effect of, well, I borrow money to buy real estate. Why would I not borrow money to buy life insurance? And the answer that I give them is, well, that's because real estate, you can walk over and see the building. You spent your entire career evaluating real estate opportunities. You've got a track record as a successful real estate investor. And so leveraging to buy real estate for you isn't actually that high risk or doesn't feel that high risk because of your track record. And by the way, you control the real estate. So you control how you deal with it, when you dispose of it, what improvements you make on it. The only thing you don't control is what the market does for your asset. When you flip to life insurance, you don't have a track record of life insurance. You don't understand how it works. You haven't spent your whole career working in that business. You don't control it. You don't really even control anything about it, actually. And so leverage for your core business isn't the same as leverage for a life insurance policy. But in my experience, some clients just like the idea of using OPM, other people's money. They're used to doing it in their own business, and they want to do it for life insurance too, even if it doesn't actually make sense. And by the way, in my experience, most of the time, these clients, by the end of that conversation, by the end of actually going through the process of getting premium financing, have decided to just pay premiums out of pocket. The last one, and I had a great case example this last year, was a client has extremely favorable lending economics with a personal bank. So this client that I talked to last year was he's a big hedge fund guy up in Connecticut, very wealthy, very smart guy, buying a big whole life policy. And basically he said, I can either pay for it out of pocket, or my bank will give me essentially a 1.25% rate lock for 10 years. And he said, I think I'm going to do the 1.25% rate lock. And I said, yeah, you should probably do the 1.25% rate lock. Now, why did he get that? Well, because he has $20-30 million on deposit with the bank. And so they obviously gave him an incredible deal and he looked at it the right way. He said, well, I either pay it out of pocket, which I can do, or I borrow the money. And in his particular situation, the lending economics were so favorable that he just said, well, I'd rather do that than pay out of pocket. My cost of money is greater than this cost of the loan. And so that, again, is not in every situation. It's not even a normal situation, but in some situations where clients have extremely favorable lending conditions, they just choose to premium finance, even if it doesn't make any sense from a planning standpoint or any other standpoint. So these are all the usual fact patterns. These are kind of the good reasons to get into a premium financing deal, falling into one of these buckets. And these clients generally understand what they're doing. They understand why they're doing it. And they generally have a more short-term, annually renewable view of the lending arrangement. They view the life insurance policy as permanent, and they view the financing structure as temporary. And that is a key thing to think about when you think about good, bad, and the ugly of premium financing. Is why are you doing premium financing? Good premium financing deals are about a temporary bridge to a permanent solution. They are not a part of the permanent solution. And as you'll see later, the bad and the ugly deals, the premium financing lives on for forever. They're both permanent. The financing deal and the policy are permanent. And you'll see why in a minute that makes sense. All right. So what are the typical lending arrangements? I know if you come from the finance side of the world, you probably want to know what the bank loan structures actually look like. So typically these are loan arrangements with commercial banks that are accustomed to lending on life insurance. So what's the difference, for example, between a premium financing loan and a loan just extended to a client for something else? Well, the difference is the collateral. What's being posted here in this situation is life insurance as collateral. Not every bank understands life insurance as collateral. A lot of them do, and increasingly even more of them do, but not every bank feels as comfortable with it as other banks. Not every bank is competing to get those types of loans the way that other banks are. And so typically you'll find situations where, for example, a very wealthy client might have a great relationship with a regional bank in Florida, for example, but that regional bank in Florida doesn't really have any experience lending on life insurance. And so what happens, they end up going to a commercial bank that does specialize in premium financing. And by the way, they don't get as good of terms as if they would go to their own personal bank, but because they're posting this collateral, that's the direction they need to go. We see loan terms typically 3 to 7 years. So these are not lifetime contracts. Again, going back to this temporary versus permanent nature, the policies are permanent. The loans are always temporary. They don't automatically renew necessarily. You've still got to be underwritten, and the terms generally go from 3 to 7 years. And in fact, in most situations, the client has to get a new lending facility every year for each additional premium that goes in. So you have to really actively manage these loans. They don't just, wouldn't it be great if you could have a permanent loan for a permanent policy? That's not the way this works. These are temporary loans for permanent policies, which is why the best types of premium financing deals focus on temporary bridges to a permanent solution, because that's also the structure of the lending arrangement. Classic spread over LIBOR, although we're obviously seeing switches to other instruments now that LIBOR is being phased out. 1-year treasuries, SOFR, stuff like that. Typically, most insurance companies require that interest is either paid current or in arrears. So you've got to pay interest out of pocket. However, and you'll see this a little bit later, there are certain companies in certain situations where the client can accrue some or all of the interest. And again, if you think about, good, bad, and ugly situations, if you really wanted to categorize, you'd say almost all of the kind of good premium financing deals pay interest out of pocket, all of it. Almost all of the bad and ugly deals accrue interest, or at least some of the interest over a long period of time. So accrual is generally a red flag. Paying interest out of pocket is generally a good sign that this is a sustainable, well-structured premium financing deal. And that's a good way to split it. Not always the case. There's certain arrangements where a very wealthy client says, I don't want to pay anything out of pocket. That's fine. As long as everyone sees it, it's a 5 to 10 year deal and they understand the risk they're taking in doing that. The last piece here is the cash value is accepted as collateral at 95 to 100%. So, again, it kind of depends on the bank. It depends on the structure. It depends on how exactly you calculate the collateral. Do you look to the next 12 months or current? But generally 95 to 100%. 95 is kind of the normal number for at least from what I've seen in premium financing deals. All right, so that's the basic setup. Now, what do these things look like when you actually get into them? So this is a classic paid interest premium financing deal. I got my little pin out right here. You can see the policy over here. We're going to illustrate this thing at 5%, for example. This is just a hypothetical example that I put together. So it's not a particular policy. It's just a generic contract. I have like an illustration software that I use for this stuff. So you're borrowing money for $100,000 a year for 7 years, which by the way would be a small premium financing deal, but makes for nice numbers. You can see the loan balance accruing right here. You can see the loan interest rate here. I just made an assumption that the loan interest rate goes up. It's kind of a standard premium financing assumption. The client in this example is paying interest out of pocket. There's a little bit of excess collateral posted above and beyond what's in the policy. And you can see the net death benefit is a little less than $1 million in the first year. It's $1.092 million minus the loan balance, which is equal to the premium payments. And, over time, as the death benefit goes up, right, the net loan balance goes up too, because the loan balance has stayed flat. Why? Because you're paying interest out of pocket. Now, this is a great example of why these things are temporary deals, not permanent deals. So what are we doing in this loan arrangement? Well, we are minimizing the initial cost to get in the policy within the first few years. However, in the long run, $33,250 to carry, call it $1.3 million of death benefit, or maybe even $1.050 million of death benefit, may not actually be as cheap as a client could have gotten had they just paid a level premium out of pocket for a stated death benefit contract. So one of the challenging things with premium financing is if you want to have collateral offset, what do you have to do? Well, you got to overfund the policy. And if you overfund the policy to generate collateral, that also means that eventually you get a big loan balance and you end up paying a lot of money out of pocket. You may end up paying more money out of pocket to maintain that coverage than you would if you just bought a guaranteed UL policy, like I said. And so that's why a lot of clients, if you're doing a premium financing deal, actually want to exit the loan arrangement after 10 years and have the policy free and clear, and potentially even take value out of the policy to help with the arrangement to keep the death benefit in force. So that's kind of the issue with paid interest financing is eventually in the long run, it's not any more advantageous than if they just bought a level pay policy up front. The advantage is in those initial few years. Now, what happens when we switch to an accrued interest deal? So the only difference here between the last slide and this slide is that now we're accruing interest every year. So you can see the client's paying nothing out of pocket. This is a free insurance deal. And in doing so, you can see the loan balance is growing pretty significantly year over year over year. All right, you can see it growing all the way up here to $1.460 million at the end of that year. Now we subtract that off of the net death benefit, and that gives us $523,000 of benefit. Now, if you look at this net death benefit, what's happening? This net death benefit is dropping over time. Why is that? Well, the simple explanation and exactly what is going on is that the loan interest accrual is accruing faster than the policy is growing. So we basically have a situation where it costs more money to borrow against the product in terms of interest than you are actually earning in the product. This is not a problem if you're paying interest because the loan balance is not growing. It is a problem if you're accruing interest because every year that goes on eats into your values. And actually you can see here, this excess collateral column, every single year, the client is having to post more and more and more collateral as the policy cash value sinks below the loan balance. So this is a very problematic scenario. And it's the reason why most people don't do accrued interest deals if you assume you're only going to earn 5%. Now, let's assume that you could earn 6.5% and do the exact same structure. And now here we're making the transition from good to, we'll call it bad before we get to ugly. What have we done here? Well, now we've created a situation where at 5%, the deal doesn't work, but at 6%, it works marvelously. Let me pitch this deal to you real quick. Mr. Client, you borrow $700,000 over 7 years. You pay nothing out of pocket. This is free insurance. You pay nothing out of pocket. All you have to do is post collateral for 4 years, and you get $1 million of death benefit in year one. And that $1 million of death benefit continues to grow all the way here. This is the 20th year to 1.084, and you continue to ride on into the sunset forever, and you get millions of dollars of death benefit without paying anything out of pocket. And that's a real pitch in today's market that I'm going to show you in just a second. Now, how did we do it? We shifted from a 5% illustrated rate to a 6.5% illustrated rate. How do you do that? Well, the way you do it is you use the concept of arbitrage. This idea that life insurance policies can outperform the loan. Now, I want you to think for a second about the change in philosophy from what we talked about in the beginning, the good deals versus the bad deals. On a good deal, there is no arbitrage between the life insurance policy and the loan. Or if there is, it's not a reason for getting into the deal. The reason why you're getting into the premium financing deal is because there's arbitrage between your outside assets and the cost of the loan, not the insurance policy and the cost of the loan. Why are you buying the insurance? And that's in the good situation, because you need the insurance. You need the coverage for estate planning. But if you're getting life insurance for free, you don't need the life insurance to justify the deal. What you need is the arbitrage. And the arbitrage is what allows you to pay nothing out of pocket and get death benefit for life. And so now the reason for the financing arrangement, the reason for the entire transaction has changed from being about planning and estate planning and the right way to fund the premiums for the insurance policy that you need no matter what, has shifted now into the reason for the transaction being the arbitrage between the insurance policy itself and the loan. Now, how do you spot an arbitrage premium financing deal? Well, the first thing you're going to see, number one here, is the illustrated rate is greater than the assumed loan rate. So basically the idea that the policy is going to grow at a faster rate than the cost of the loan. The second piece is that you're going to see fully or partially accrued interest. That's a classic sign of an arbitrage premium financing deal. Now, as you're going to see, fully accrued interest, not very common. Partially accrued interest, very common. And the last piece, and this is probably the biggest telltale sign, is the policy, the bank loan is exited via a policy loan. Now, again, if you want to put it in actual technical terms, the bank loan isn't exited. It's just refinanced with a policy loan. So what do these deals look like? Or actually, I'm sorry, what's the history of these deals? So quick, brief history of this. This has been around, this concept of arbitrage between life insurance and loan rates has been around for a very long time. In fact, a friend of mine recently who runs a premium financing shop told me that this started in like the 90s when people realized they could do this. And so to give you an example of how this works, here's the Northwestern Mutual dividend rate, which is a very good indicator of kind of earned rates for life insurance company portfolios. Now, remember, when a life insurance company takes premium in, they put it in with all the other assets that they have, and they take an average rate across all those assets. And that's the rate that you get. Now, when you're borrowing money from a bank, you're paying rates that are based on today's interest rates. So there's a natural disconnect between the earned rate at the insurance company based on a portfolio of assets, some old, some new, and the new money rates today. Now, if new money rates are falling, that gives an advantage to the portfolio rate. So here we have the Moody's AAA composite. It's just a basic gauge of kind of risk-free rates or low risk corporate rates in the market. And you can see that obviously over the last 30 plus years, the Moody's AAA has been falling, and so has the dividend rate, but there's been a constant spread between the two. Now, there are two explanations for this. One is that this is a natural, sustainable arbitrage between the insurance company's dividend rate and the AAA bond composite. In other words, that life insurance companies consistently, reliably, and predictably generate better returns than the corporate bonds that they invest in. Think about that. Life insurance companies buy corporate bonds. If you were just to look at the last 30 years of history, you might come to the conclusion that life insurance companies outperform their own new money investments. That makes no sense. So what is going on? What's going on is you have portfolio rate and you have a new money rate. If you look over the broader history of time, you'll see that in a falling rate environment, That's a good thing. In a rising rate environment, that's a bad thing. Here's a Northwestern Mutual dividend from 1955 until 1985. And here's AAA bonds. There's we'll use the term, right? This is a negative arbitrage between the two. And so but for the purposes of pitching it to clients, a lot of times agents will say, oh, well, this is an arbitrage here between the crediting rate in the policy or the dividend rate in the whole life contract and what you can borrow. That's not arbitrage. That's a temporary phenomenon that will invert necessarily in a rising rate environment. However, what we're seeing today is not so much of those deals and more IUL deals, premium financing with IUL. And these are real proposals that people have sent me over the last couple of years that I find to be immensely entertaining. In fact, I mean, sometimes I have to try not to smirk when I see these things because they're so ridiculous. These are real clients, real deals, real proposals. Take this client right here. He's a 49-year-old male. This guy lives in Kentucky, $235,000 a year. Their client has pitched a nominal payment into the contract of $15,000 a year. All of the other loans are rolled up over time. Client has to post collateral, all right? But all they got to do is pay $15,000 a year. If you'll notice here, it says lender loan repayment. Yes, that's lender loan repayment with a policy loan. And then from there, the client can take out, as illustrated, $220,000 a year of income for the rest of his life. So what's the pitch? The pitch is, Mr. Client, buy this life insurance policy, pay $15,000 a year for 15 years. We're going to exit the loan. So you're going to have no more risk after the 16th year. And then you get $220,000 of income for the rest of your life. And all you have to do is pay $15,000 and post $350,000 collateral, which is way better than paying $235,000 out of pocket. And you get $220,000 of income for life. Now, what's the need here? Well, the client wants and maybe needs income. What's the solution? A deal that looks absolutely unbelievable. For example, here's the IRR on net cash value of what the client has paid, what the client has received, and the cash value left over. And you can see the IRR here is 17.45%. That makes clients, even smart clients, drool because nobody is talking about 17%. And by the way, it's all tax-free. All right, sample arbitrage number 2. Again, same vendor that set up this deal, but a totally different situation. This guy is 64 years old. The pitch was to do a 1035 exchange. Do a 1035 exchange of $1.5 million out of an old Northwestern policy, put it into, which by the way, was perfectly healthy and doing everything it was supposed to do, to borrow then an additional $10 million over the next 9 years, pay nothing out of pocket, exit the loan with a policy loan, post a little bit of collateral right here in the hump, and get $400,000 of income for the rest of his life. Now, I'm happy to say this client didn't do this. The other shocking thing, this client's net worth, guess what client would be qualified for this? I guarantee it's not this guy. His net worth was $5 million. And so this pitch was to borrow $10 million with a net worth of $5 million. I'm not even sure the financing could have been done, and yet this is what was shown to the client. All right, deal number 3, again, just throwing some more at you. Very similar concept here. $3.3 million a year in premiums, $1.5 million out of pocket. This is a different client, just happens to be a similar number there. All right, loan repayment with a policy loan. And again, you get IRRs at death of 11% by the time this client, he's 66, by the time this client is 100. So an incredibly attractive deal. This is another one of my favorites here, $25,000 a year. All right, $463,000 a year on this 46-year-old. Repayment, if you'll notice, that is actually a policy loan. And then you get income of $255,000 a year for several years. And again, all you have to do is post this collateral right here. All right, and then this last one is perhaps the most interesting. This is a client who borrows $80,000 a year for 10 years, pays 25% of the first 5 years. I'm sorry, 50% of the first 5 years of premium payments, pays back the bank $933 with a policy loan, and then takes $88,000 of income for the rest of his life. Now, what's interesting about this one is this is a client who would not be, this is not a qualified investor. This is a client who this $79,000 or $38,000 represents the bulk of their net worth. They are not, I think the net worth in this client was less than $1 million. And yet this was being pitched as a part of a corporate benefits deal for the client to borrow money to buy life insurance to get essentially low cost income with obviously a huge IRR. I think the IRR on this was like 11% or so by the end. So what's going on here? Well, what's going on here is indexed UL is providing that arbitrage to illustrate things like this. All of these arrangements are indexed UL contracts. And so, so I took way more time going through the good of premium financing than I meant to, but I just want to briefly go through why arbitrage and indexed UL doesn't exist. So first and foremost, what is an indexed UL product? Well, an indexed UL product is a universal life product that has the credits tied to the performance of an external index. You get a guaranteed floor and you get a non-guaranteed cap. Now, how does a carrier invest the money? Well, they take the money, they put it in the general account yield, then they go out and they buy call options, and the call options exactly replicate the exposure of the index crediting. So they exactly replicate. So essentially what we've got going on here is an options strategy. So rather than buying just fixed income, like in a traditional UL product, they're taking the fixed income yield and going out and buying call options. Now, why would we assume that this illustrates some sort of arbitrage? Well, the reason is not because it does actually, in fact, do that. It's because it illustrates differently than any other life insurance policy out there. So with whole life, you've got the general account yield fueling dividend interest rates, and therefore you illustrate dividends based on your current dividend rate. Universal life, general account yield, creating a crediting rate, then fueling an illustrated crediting rate, and these two things are the same. Here we have a general account yield going to fund an option budget, which you can't see. All we know is that it buys this cap, and then we convert the cap into this illustrated rate. And so the first thing right away to know is that the concept of arbitrage, if you think about the basic idea behind arbitrage, is that it's the idea of, buying cotton in New York and then selling it in London at the same time for a profit that's greater than the cost to ship the cotton or whatever you're, selling, your tobacco or whatever it is, right? This is back in the, 1800s days, you're thinking about that sort of thing. Here, we're putting it in that same concept of arbitrage, but what's really going on is it's actually a fundamentally different structure. And it illustrates differently because we're talking about non-guaranteed caps and those producing illustrated rates. So how does the industry do that? Well, the industry basically does a hypothetical look back where they say, all right, if you have a current cap today of 10%, we're gonna go back and look at S&P 500 data. We're gonna start here in January 15, 1970. We'll look at 25 years worth of data. And we're gonna say, all right, what did the index actually do over that period of time? What's the average return you would have gotten over those 25 years? Then we're going to repeat that calculation every day from 1955 until 2020, and we get a 6.2% illustrated rate. So again, think about the concept of arbitrage. On the index UL illustration, we are getting the 6.2% rate that makes it look like free insurance. We're borrowing money at 3 and we're earning 6.2. But we're not actually earning 6.2. Instead, what's the carrier actually giving you? Well, the carrier is actually giving you a 10% cap. By the way, this non-guaranteed cap, it can change. What you actually earn is going to bounce around every year. So you don't know if you're going to get the cap. You don't know if you're going to get the floor. You don't know if you're going to get something in between. All you know is that it's not a stable rate arbitrage. Now, if you go back to all these proposals right here, you'll see that these are all stable rate arbitrage. Look at this nice, easy, collateral increasing and then decreasing slope. That's not the real world. Instead, we have a volatile and variable crediting rate. So what do you know right away? You know that collateral actually is going to bounce around quite a bit. You also know that that 6.2% isn't a real 6.2%. This isn't taking tobacco in Virginia and selling it in London. This is potentially you could earn 6.2, but the loan cost you today 3%. And so the right way to think about that 6.2 is to take this exact same calculation and put it in the context of other historical numbers. So this is a hypothetical historical calculation. It uses historical equity data, but a hypothetical cap assumption. If we looked at this in context of VUL, we'd say, all right, well, we get 6% for IUL looking back over the same historical period of time. And that would be, I'm sorry, I skipped a slide. That would be about a 50% success rate. So basically, if you take the average of all those 25,000, all those 25-year periods, the average is the illustrated rate. That means about half of the time you're worse and half of the time you're better. If you did the same thing with historical equity returns, you get about 11%. So what that means is when you illustrate IUL at 6%, from a risk standpoint, that is equivalent to illustrating VUL at 11%. So this 6% is extremely risky. And if you were to believe that VUL did 11%, then what would you want to premium finance? Now, of course, Reg T will stop you. But what's the real arbitrage opportunity? It's to go buy a VUL product and illustrate it at 11%. So this isn't really arbitrage. This is actually volatile. This is a very volatile result. And yet on the proposals, you don't see that volatility. And you can see here that basically, VUL at 6% has a very high likelihood of working versus IUL at 6%. And IUL at 6% is actually, again, very risky. It's equivalent to running VUL or assuming equity total returns at 11%. All right, so the other thing going on is that caps are falling significantly. So this is a case study from one life insurance company. We assumed a second ago caps at 10%. Over the last 10 years, caps have fallen precipitously. This is, again, one example of one life insurance company. They started out with a 16% cap in 2009, and now they are at an 8.5% cap in 2021. What does that mean for the illustrated rate? Well, that means the illustrated rate drops whenever there's a cap reduction. And so now our 6% cap is unattainable. It's essentially equivalent to a 5% cap. To a 5% illustrated rate if the cap drops from 10 to 8. And again, a cap dropping from 10 to 8 is not out of this realm of possibility, given that we've fallen from 16 all the way down to 8.5% since 2009. All right, so I'm going to skip all this sort of stuff other than to say these deals don't really work, which I think you probably get, and cut right to the meat of it, which is, all right, so we look at all these premium financing arbitrage deals. What are the pressure points? And I've kind of alluded to all these things, but I want to bring it back home and talk about specifically what happens in these arbitrage financing deals that make them blow up. First things first is in the real estate game, it's location, location, location. And premium financing with arbitrage financing, it's collateral, collateral, collateral. So I'll give you a real example. There was a client down in Texas who bought $200 million of premium finance, free insurance, IUL, never paid anything out of pocket. His economics in that deal might have worked out fine in the long run, but the reason why it blew up after 7 years was because of collateral. Every single year, the client was getting bigger and bigger and bigger, unexpected collateral calls. Now, we would all like to think that clients will stay in the deal long enough to see if things reverse, but that's not the way this happens. The way it typically happens is the client was told to anticipate $500,000 in collateral, and instead, every time the index does a zero or the cap drops and they don't get quite what they thought they were going to get, you start getting collateral calls. And these collateral calls are real cash that the client has to collateralize, and that is a painful conversation every year. And so many clients pull the rug out from under a deal simply because they had unrealistically low collateral assumptions about what they would end up having to pay. And again, that's a natural part of an index 2L product. It's not arbitrage. You're just taking risk. And when you take risk and volatility, you're going to have collateral calls, and that's what blows these deals up. Second thing going on, and these two and three are kind of related, cap reductions and illustrated rate reductions. So as I mentioned, caps have been coming down. So a lot of these premium financing deals worked great as arbitrage structures when the caps were 10, 12, 13%, and you were getting illustrated rates of 6.5%, 7%, 7.5%. Now caps across the industry are pretty much dropping into the 8.5%, 9% range, and they're going to keep going down. Whenever that happens, the illustrated rate goes down too, which means that when a client does an in-force projection, the arbitrage in a lot of situations goes away. It doesn't exist anymore. It never existed to begin with. It was all fabricated based on the illustrated rate, based on very aggressive equity assumptions, based on a current cap assumption. But if you just run literally just a regular old in-force illustration, you'll see that the deals that used to work don't really work anymore. Regulation changes. So we've seen changes to Index 2L illustration regulations. There was one that got put in earlier this year, and I talked to plenty of premium financing vendors who said, literally, my deals don't work anymore because the regulation changes, because it impacts illustrated performance. This is kind of a sneaky one, bank loan renewals. I have heard from some premium financing vendors that when clients who don't have a sufficient net worth borrow to do a premium financing deal, there can be times where the loan will not get renewed because the client's assets as a ratio of the loan essentially don't match up, and the client no longer qualifies to do a renewal. And then it's all hands on deck to try to figure out what to do. And it's been a big disaster in a couple of situations. And the last piece is, look, client circumstances change. And some clients get into these deals thinking long-term, and the reality is There's situations, they're not, maybe they lost some money. They don't have the liquidity they thought they were going to have. They thought they were going to have collateral, but they can't post it. All sorts of things happen with clients where if you're in an arbitrage deal, because the expectation is free insurance, as long as you're willing to do these things, sometimes clients can't do those things and these deals no longer work. So these are the typical pressure points in arbitrage financing. And unfortunately, far too often, these are the deals that I see in the market, these free insurance transactions that are based on the concept of arbitrage that doesn't really exist. And when you actually, when they are sold and you actually see them in flight, these are the things that blow those deals up. And I'd say I've seen a lot of these deals that haven't worked. Now, some of them have. We've had a great run in equities for the last 10 years. Interest rates have been low. So there have been a lot of arbitrage premium financing deals that haven't blown up. That doesn't mean the next 10 years are going to look like the last 10 years. The last 10 years were perfect for premium financing. The next 10 years is probably not going to be perfect. It's certainly not as perfect as the last 10 years. All right, so last piece here. How do you do this right? So remember, the purpose of premium financing and when it's done well is when it leverages external assets, not the policy. So when the client has something else they don't want to take money out of to put into life insurance, they've got something else they want to put their money into. And premium financing is a bridge between the permanent need and the temporary funding. That's it. The loan exit strategy should use external funds, not the policy values, or at least not all of the policy values. So the idea should be that there should be a sale of a company, a transfer into the trust, whatever, a refinancing, whatever it may be, that will free up funds to, again, turn a permanent policy into a permanent policy without a loan on it, to get rid of that temporary bridge. So that should be done with external funds, not with policy values, or at least not entirely with policy values. Clients should pay loan interest out of pocket every year. I've seen very, very, very few scenarios where accrued interest makes sense. And there are some, but very few. And typically those are the ones where this arbitrage concept is being pushed all the way to the max. So for most clients, paying loan interest out of pocket every year is the way to go. If you see an IUL financing deal, whatever the maximum collateral is on the illustration that you're seeing from the vendor, you should expect to put away 3 times that amount for actual collateral calls, simply because of the volatility of the crediting methodology. And to also mitigate that effect, illustrate conservatively. Don't take the 6% rate. Remember, the 6% rate in IUL is equivalent to 11% in VUL. That is an incredibly risky deal. Instead, illustrate conservatively. One of the things I always say, kind of one of my axioms, and this is one of the things I tell clients too, is I say, look, go back to the premium financing vendor and ask them to rerun that proposal at 4%. And if that proposal does not work at 4%, then you are taking a ton of risk in this transaction. If the proposal does work at 4%, and by the way, a proposal that uses external funds to exit the loan, pays interest out of pocket, will work under 4%. So those types of structures are already conservative and they will work under lower illustrated rates. That's kind of an acid test, like a litmus test for the aggressiveness of the deal. So always ask for 2 illustrations. The one that the premium financing vendor showed, probably showing the maximum illustrated rate, the most risky outcome for the client, with the least amount of collateral strain, versus a more conservative illustration with a higher collateral expectation for the client. And the last piece, and I think this is really important, is the client needs to be prepared to have regular reviews of the transaction. Premium financing, especially with IUL, is the opposite of a set it and forget it product. This is an actively managed strategy. You have to actively manage the policy and you have to actively manage the financing vehicle. Clients who are not willing to have a couple of meetings a year, deep dive meetings a year on the status of the transaction and what to be done over the next year, should not get into premium financing. In fact, I was talking to a client a few weeks ago who was looking at a premium financing deal. And, I think he liked the idea of arbitrage and all this kind of stuff. And he said, oh yeah, I'm wealthy enough. I can give this a shot. We'll see what happens. Maybe I get free insurance. Maybe I don't. What really spooked him was the administration and just the fact that he's a very wealthy guy and he's very busy and he doesn't want to have to think about this. And with premium financing, you got to think about it. You've got to actively manage it. You got to have advisors you trust that are really holding your hand throughout the process. And for some clients, that's just too much time and attention for what is ultimately a sideshow part of their financial plan. as it often is with these premium financing deals, where it's an arbitrage concept, it's an investment play rather than a clear insurance need. So that is the good, the bad, and the ugly. Again, I think there's a lot of good here potentially in premium financing if you're set it up under the right scenario with the right client. But what I see that's so worrying is the bad and the ugly, which these days is the concept of free or low cost life insurance, where honestly, the life insurance is incidental. It's all about this concept of arbitrage. It's about generating income tax free income at a minimal possible cost. It's about double digit IRRs. That's everything wrong with premium financing. And honestly, that's everything wrong with life insurance. If you look back over our history, we are at our best as an industry when we are selling what we uniquely can offer, which is powerful life insurance solutions. We are at our worst when we're trying to turn life insurance into a financial arbitrage tool. And we have done it so many times with vanishing premium, UL at 12% in the 80s, VUL at 12% in the 90s, Stoli in the mid 2000s. And here we are again, premium financed IUL, the same concept of arbitrage. And you know what? We know exactly how it's going to end. And that is the ugly part of our industry that I hope, at least for my part, and I know I think I speak for BUI too, is going to be short-lived. This is not going to be here forever. And that's certainly my hope. But like I said, there's some good about premium financing too. Just make sure you steer clear of the bad and the ugly. So with that, Brant, I'm finished with my formal section. I'm happy to flip it over to you for questions or however you want to handle it.
Yeah, Bobby, excellent. Again, you covered tremendous amount of information in a very understandable and helpful way. I have been bombarded with questions, and they are very good ones. One quick thing, there's a ton of CFPs on this call, and not a ton of CFPs signed in for the CE. So please go in the chat if you haven't already. Make sure you get your CE. The most common question, this is recorded. I will send it out before the end of the week. Second most common question. So you did a great job of explaining why someone might not want to get in one of these hyper aggressive deals. But what happens when your client walks in 2 or 3 years in?
Yeah.
So somebody's already into the deal. What's the path out?
I had these conversations regularly. I'll say this: it depends. And the thing I always ask is, why is this person thinking they need to get out of the deal? There's a bunch of reasons. So the main one I see, as I mentioned earlier, is collateral strain. The client they've posted all this collateral. They don't understand what the deal is and they don't want to post, or they can't post more collateral. I mean, I saw a client, he's probably worth $400 million on paper, could not meet a $1.5 million collateral call because he was already fully levered up. He had to exit the deal. Now, in that situation, it turned out that he was fraudulently induced to get into that transaction. The policies were not funded correctly. There were forged signatures. I mean, you literally could not imagine the mess that this guy found himself in. And of course, he's suing everyone, and it's a crazy deal, right? But what was the trigger there? The trigger was collateral. The other trigger that I see is kind of this loss of faith. Like people just sort of say, hey, I just don't think it's going to work anymore. The cap came down. And so then the question is, all right, how do you get out of it? So on the collateral side, if the client can't post collateral, you got to cut and run. And that's what this person and this one client did. He basically said, I'm out of this deal. He renegotiated with the lenders, and he essentially had to go out and buy 10-year term insurance and basically say, I made a mistake. I didn't know what I was getting into. Obviously, I was not handled correctly, but I've got to cut my losses, stroke the check, and be done. Other situations where the client's lost the faith, you kind of have to take a little more circumspect approach and say, look, you're already 3 or 4 years in. You might have, for example, in your policy, a return of premium rider that goes for 7 years. You might be able to post collateral. Maybe it makes sense just to kind of ride this out for a few more years and kind of see what happens. Maybe you start paying interest if you were accruing interest. Maybe you pay down some of the debt. Maybe you restructure the policy a little bit, reduce the death benefit, whatever it may be, to make this a more sustainable arrangement. So I think that's really always the question is, why do you think you need to do something about this? If it's collateral, there's nothing you can do. You have to cut losses. That's the end, and figure out how to make the best of it in a very bad situation. And again, I've seen clients stroke multi-million-dollar checks to get out of these deals when collateral is the problem, because they literally have no other option and they can't post any more collateral to stay into it. On the other side, some people want to stick around for a few more years, and that's okay too. And again, you do the annual dance every year of do you stay or do you not? But I'll tell you what, it's never a comfortable conversation. It is always unpleasant. Clients never want to feel like they got duped. And that's always the way they feel. And so I'd say handle any of these conversations, with a lot of delicacy, because it may end up costing them a lot of money. And they're going to realize that the further along you get in the process.
Got it. Okay. So you shared some ugly ledgers, and there are a number of questions regarding if those ledgers are carrier provided NAIC regulated ledgers.
No, these are premium financing vendors make stuff up. They copy paste out of the illustration. They throw it in their own spreadsheet, and that's that. So no, there's no regulation for this. And actually, a lot of these guys aren't even allowed to do it. Like the carrier tells them they can't do it, and they do it anyway. And I've even heard some crazy stories now about how some premium financing vendors are creating their own illustrations to get around the new regulations for IUL, and then taking that output and putting it into spreadsheets and showing it to clients. I haven't seen one of those personally, but people have told me that they have seen them. They are out there.
Well, that's an exciting thing to look forward to.
Yeah.
So, Bobby, there is also some request for a delineation between premium finance and private finance. I'm not sure if you want to field that, or if we should ask Brian to field that.
Yeah, I'd say Brian's probably the more resident expert, at least on the BUI side for that. I don't know, Brian, if you want to hit that a little bit.
Yeah, sure. Absolutely. So premium finance is a lot more complicated than private finance. So private finance is actually a little more straightforward. It's a popular estate planning technique, and it is usually designed for clients who have already used their lifetime gifting exemption, or they are directing gifts to their kids and they don't want to stop gifting. Well, how else can you get money into an irrevocable trust to fund a life insurance policy? And that's when the client would make a loan to the trust. Now, what makes it attractive right now is interest rates. The long-term applicable federal rate right now, well, for next month is just over 2%. So client loans the money to the trust, and the trust has to invest those funds, make a little bit of interest payment back to the client, but ultimately you've got cash in the trust that's available to pay the life insurance premiums without using any gifting exemption. So it's a really powerful planning technique, and there are generally no tax consequences on the income tax side because it's a grantor trust for income tax purposes usually. So a great strategy for the right client. And like I said, a lot fewer moving parts than you see with premium finance.
Yep.
Great. Thank you, Brian. Bobby, back to you. So you mentioned dropping caps and how that could be problematic for clients.
Yep.
And you also had your own software that you've been using to kind of show us the problem. How would an advisor help a client show them the problem? How would they, I hate to use the word illustrate because it's the connotation of a life insurance illustration, but how would, a client that had an IUL cap at 12, it's now at 8.5, how do you show the client what that actually means?
Well, it's so easy. Get an in-force illustration. That's it. I mean, every single new in-force illustration, or every single in-force illustration has to reflect the current cap. It will still be run at the aggressive, AG 49 maximum rate. So I know we've got a question here from Guy about IUL at 6% equals VUL at 12%. Yeah, that is exactly the math. I mean, think about how that calculation runs. It uses historical S&P data. Well, what has the historical S&P total return been over the period of time used for the IUL illustrated rate? It's 12.5%. So yeah, I mean, equity returns are really, really high historically, and that's informing that IUL illustrated rate at 6%. That's the same exact data. So if you want IUL at 6, you have to use the assumption of VUL at 12.5. That's in terms of annual returns, that's the way to think about it. So when you get an in-force illustration, it's going to adjust based on the cap. It's still going to use the very aggressive equity assumption. So I'd say you probably actually do two ways to demonstrate it. Way number one is say, look, just take the maximum rate, which again is this average of historical returns, so 50% success probability, assuming a 12.5% equity return, assuming the cap isn't going to go down anymore. So this is a very aggressive assumption. We're going to take those numbers, put it into your plan, and we're going to take a more realistic view, which is to say, and this is very intuitive, The carrier is earning money on its investments, and then it takes that yield and goes on and buy options. Let's forget the options thing. Let's just run the illustration of what the carrier is earning on its own assets. So what the carrier is investing in. And if you run that rate, it's 4.25%. And if you run it like that, that's another way of looking at the sustainability of your deal. So I always advocate those two numbers, the maximum AG 49 rate, which is a very aggressive rate based on your current cap, which has come down, and then rerunning it at a more realistic rate based on what the carrier is actually earning. And those should be the two data points you're using to evaluate the health of the transaction. You got to have both though, because if you just go with the higher number, you're going to get a false perception of security that lulled you into the deal the first time. And that's going to change. The 4% rate is much more sustainable, much less volatile, much more reliable, and frankly, much more realistic as a long-term performance.
Thank you. I apologize to everybody. There's so many questions. I'm not going to be able to get to them all. Just try to get to the ones that are most common here. I guess the last question here will be, you've clearly reviewed a lot of these deals.
Yeah.
Of the leverage deals where you're essentially repaying the loan with the cash from the policy, have you ever seen it play out as illustrated? And do you see any differentiation between whole life and IUL? I'm trying to kind of combine a few.
Yeah. I see what you're doing. Have I ever seen it work? Yes. I mean, again, think about the last 10 years. Equity markets, this is a stat I think people don't really realize. Since 2010, the average S&P total return has been like 16.5%. So we have had the best run of equities probably in the history of mankind. And IULs have been absolutely a beneficiary of that. So even though caps have been coming down, credits have been strong, and you combine that with an ultra low interest rate environment, yes, these deals have done surprisingly well in the last 10 years. But think about what you would need to believe they're going to do equally as well in the next 10 years. You would need to believe that caps go from 8% back up to 13 or 14%, where they were in 2015. There's no way in God's green earth that's going to happen. All right. That's number one. Number two, you need to believe that equities are going to rip at another 16% per year for the next decade. And you would need to believe that interest rates continue to fall and stay down at 1% or less, which is where they were back in 2014. So if you believe those three things, then you can reliably say that these premium financing deals are probably going to do pretty well over the next few years. I would argue all three of those things are at this point like physical impossibilities. So the last 10 years has been very friendly. The next 10 years will not be so friendly. And then real quick, I'm glad Andy brought up this question about whole life versus IUL. We spent a lot of time talking about IUL. I do see arbitrage deals in whole life too. And you got to be careful of those as well. But this is the analogy I gave to the head of one of the US businesses in whole life who does some premium financing. I said, look, you got to understand, like IUL premium financing is you're driving down the street, you're going through an intersection and you get completely broadsided. You never even saw it coming. Your car flips over and burns in flames. Yeah, within the space of like 30 seconds. That's what happens in IUL deals. I mean, everything's going great and then boom, it's over. With whole life, man, it's like you see way down the road the driver careening, across the street, and you can pull the car over and you can stop and, because think about it, whole life dividends don't change that much from year to year. They're reliable, they're consistent. You kind of know what's coming. So with IUL, you don't know if you're going to 0 or a 12 or a 10 or a multiplier or a negative, or, you don't know anything like what you're going to get. With a dividend, you're going to get something. Now, it may be 25 basis points or 50 basis points or whatever less than you thought, but you can see that coming from a million miles away. You can see the problem way down the road, and that allows you to deal with it. You can pay premiums out of pocket. You can pay interest out of pocket. You can pay back some of the loan. There's so many things you can do to mitigate a bad whole life premium financing transaction that you just flat out don't have the time to do in an IUL premium financing transaction. And that is the big difference. Arbitrage is not good in either scenario. You don't want to sell a deal based on arbitrage, but at least with whole life, you can deal with it and it won't be catastrophic. You can deal with things ahead of time. With IUL, like I said, I mean, you get hit, the car flips over and everybody burns. And that is when an IUL goes south. That is what happens.
Excellent. Well, Bobby, you've been very generous with your time as always. Another incredible presentation.
Thank you.
Please make sure that I'm going to be sending these slides, this recording out in mass. So if you don't see it before the end of the week, please check your spam or junk folder. But I will get this out. A big thank you to everybody for your continued partnership. And just a final reminder, if you are in an advisor group and you would like an update on legislative changes, use your resource in Brian Siegel. He's a wealth of knowledge and can really help you with your planning. Enjoy the rest of your day, and thank you again for attending. Take care.